What's up, everyone? It's Caddy with MoneyVest. A lot of you guys have been asking for an analysis on this company, and that is exactly what we are going to discuss in this video. I'm going to break down e.l.f. Beauty, so ticker symbol e.l.f, and we're going to figure out whether this stock is actually undervalued or if there's more potential for downside with this company. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. I would really appreciate it. A little bit of a different layout moving forward because I've kind of rearranged some of the things. So again, make sure that you drop a like, subscribe to the channel. And again, links to our Discord and Patreon is going to be down below. Would love to have you on board. And again, you can join the Patreon, join Discord, unlock over 40 plus members only private videos. You can also access all the spreadsheets, all of the S&P 500 valuations, intrinsic values, volatility cheat sheets, everything's going to be available. And of course, you can unlock over 20 Discord channels, including trade ideas and trade alerts and options alerts and discussion channels as well. So there is a 16% annual discount with a link down below. And again, we'd love to have you on board. So let's dive right into it. e.l.f. is a beauty stock, right? e.l.f. Beauty, that's what it's called. I've actually done an analysis on this company before. We've talked about this very company, and it is absolutely phenomenal in terms of how well the growth has been. I mean, if you take a look at since 2020, the stock has been on this insane run up of over 1,200%. At one point, it was up over 1,700%, trading at an all-time high of well over $140, and it has sold off over 34%. So the question now is whether this stock or whether this company is a buying opportunity. The market cap sitting at $5.2 billion, and you can kind of see on an annual basis, the revenue and the margins and earnings have absolutely exploded for this company as well. So if you take a look at the 6 months ending in September 30th, so this is the second quarter fiscal year 23 earnings that the company reported on 1st November, $431 million, and that's up from $245 million. So if you do the math here, we're looking at 431 divided by 245. That's a 76% growth on a year-over-year basis. And for this second quarter, the growth was, I think, over 70%, 76%, right? 76% growth on a net sales basis. Gross profit was more than doubled, almost doubled to $305 million, and that's up from $162 million. So if you take a look, 305 divided by 162, we're looking at an 87% growth on the gross profit. And bottom line, net income, $86 million, and that's up from $26 million. That's, I think, over 200%. If you do the math here now, 86 divided by 26, we're looking at a growth of over 300%. And for the second quarter alone, that was more than twice, 33 divided by 11. Again, we're looking at 300% growth, or 3x growth here for the company. So absolutely phenomenal numbers, no doubt about it. And the beauty products, man, beauty products continue to do really well. I think Ulta Beauty is kind of like in a very similar ship where it continues to perform really well. It has also been selling off from highs of 550s. It is down the same as e.l.f, down over 32%. But if you take a look at, from the pandemic lows, the stock's up over 167%. Actually, it is a lot less compared to what e.l.f is doing. And revenues, earnings have grown over the last couple of years. Margins have also expanded a little bit for Ulta Beauty as well. So going back over to e.l.f, this right here is going to be the balance sheet. So they are sitting on cash and cash equivalents of about $167.7 million, with the total assets at $747 million. Now, goodwill and intangibles kind of make up over $200 million, which 200 divided by 746, we're looking at a number, 26%, which I guess is reasonable. I look for this number under 10% because I don't want goodwill and intangibles to be a pretty sizable chunk of their overall total assets. For e.l.f, it's about 26%, so that's, I guess, okay. And current assets are $435 million, with inventory levels sitting at $33.7 million, right? So $33.7 million divided by the overall assets of 746, we're looking at less than 5% of inventory, right? So less than 5%, meaning that their inventory management is really good and they are selling everything that they're producing, right? So very, very low levels of inventory is always a good thing for the business that's, again, making a lot of products. So we've got cash and cash equivalents sitting at $167 million, investments another 1.1 million, so that's nearly 168, and they've got total long-term debt and liabilities and obligations at $57 million, right? So that's, again, a very, very good balance sheet for the company because they've got more cash than debt on the balance sheet. Total liabilities are $230 million, and their total cash is sitting at $168 million, right? So they've got almost, not almost a lot of cash on the balance sheet to pay down a significant chunk of their balance sheet. In other words, 167 divided by 230, we're looking at 72%. So in other words, they've got 72% of their liabilities can be paid down by the cash that they have on the balance sheet, right? So that's again pretty good. And current assets do exceed current liabilities by a substantial amount. So the current ratio is well over 3, and the quick ratio is also well over 2.5, close to 3 when you take inventories out. So we've got an excellent balance sheet. We've got growing revenues and profitability. This right here is the last 9 to 10 years worth of history. So you can see the consistency with the company, and more specifically, the last couple years, you'll notice the business has exploded as there's been a significant demand in overall products for what they offer. And gross profit has also gone parabolic a little bit. There's no longer linear growth, but it's happening a little bit more on an exponential basis. Same thing with operating income as well. So there's a lot of operating leverage now starting to kick in. And shares outstanding have also increased by not by a whole lot. So they've gone from 45, 46, 47 million to well over 50, 52, 53 million. So they're kind of increasing share count by about 1 million shares per year, which I guess is not a big deal for the company. Very strong profitability margins. So we're looking at 70% gross margins, net margins of over 15.8%. And this, I think, is going to continue to improve for the company, considering that they've got a very nice operating leverage. Return on capital assets is also really good, with a return on common equity at over 27%. So this is a business which is extremely efficient right now. And return on capital equity and assets is very good. We've got excellent margins, growing business, and a phenomenal balance sheet. So it does kind of check off a lot of the boxes, and it's not doing a lot of share dilution either. However, when the business is so good, we know what's going to be the problem, right? We know this, and that's going to be the valuation. Now, valuation is expensive if you take a look at e.l.f., even on a growth adjusted basis. So if you take a look at the price earnings multiple, we're looking at anything that's over 35 to 45. Then price to sales, we're looking at over 5.7 to 6.6. Price to cash flow at over 47, and enterprise value to EBITDA sitting at over 24. So, the PEG ratio is 1.36, which may suggest that, okay, it's actually quite reasonable. But if you take a look at the growth forecast on a non-GAAP basis for e.l.f., the growth is expected to be at around 20% on a compounded basis. The reason why the PEG ratio is quite reasonable at 1.36 is because it's only forecasting for the next 12 months out, right? Forward basis. Forward. So right now it says, how it says forward. Forward is next 12 months. And that's why the PEG ratio is quite reasonable at 1.36, because the next year's growth, basically 2024, analysts are expecting almost a 60% growth in earnings. But then, of course, it moderates down to 16%, then down to 23, 24%. So when we're doing our analysis, we're not just looking out next 12 months, we're looking at next 60 months, basically the next 5 years, 5 to 10 years is what we're really forecasting for. And for those reasons, I think the valuation is a little too high. Yes, it can actually end up performing really well when the earnings do come out and they report some very stellar numbers, year-over-year growth, and Wall Street likes to see that. And it could see, significant jumps and bounces back higher. But from a long-term perspective, that's exactly what we have to calculate. What's going to be the intrinsic value for this business today based on the next 5 years worth of cash flows and actual earnings. So if you come over to our calculation, so what I've done here is I've taken into account 2023 net income of about 142 million, right? So if you come back to the actual income statement, so far they've done $86 million. If I annualize this number, it's going to be closer to 170. So I think I can maybe go up as high as 165 just to be on the reasonable side. $165 million is going to be the potential forecasted net income for e.l.f. The growth rate, right? So growth rate compounded for the next 3 years is expected at around 20%. So this right here is the 20% growth that analysts are expecting, but that's only for 3 years. So what I'm going to do is I'm going to assume that the next 5 years, business is going to moderate a little bit. Growth rates are going to slow down, and I'm going to give them an 18% growth. I think that's still quite a reasonable growth rate. Now, PE multiple, it's trading at 35 and 45. I'm going to bring this down quite a notch, bring it down to, let's say, 24 to be on the safe side. And I don't think it pays a dividend. So come down here a little bit. So there's no dividend that the company is paying. So we're going to assume 12% discount rate, 10% margin of safety. And we're looking at a share dilution of, let's say, 0.5%, because they have been issuing at least 1 million shares per year in the last 5 to 10 years. So we're looking at about an $81.75 as the actual intrinsic value, which is actually not bad. It's at $95, only a 14% pullback needed in order for this to be trading at an intrinsic value, which I assume to be fairly valued here. And that's going to be based off of a 24 times price earnings multiple, which means compression from the current levels, and a growth rate, which is, I think, quite reasonable at 18%. If they can grow at 18% over the next 5 years and demand a 24 times P multiple, then 81.75 is going to be that intrinsic value for the business. But of course, if you do assume, different numbers, so for example, if you think 22 multiple with a 16% growth rate is quite appropriate, then we're looking at sub $70 for the company. But it just really depends, like I said, on the analyst and what you're looking for in terms of, the growth rates and the P multiples. But for me, I think anything under $80 is going to start making a lot of sense for this company. Now, we are starting to roll over, but there was a lot of negative divergence on the weekly chart where the price continued to move higher and higher. It was kind of making, significant amount of all-time highs here. And then, of course, getting rejected at that resistance and started to roll right back down. And the next support, the most important support level, is going to be sitting right there at close to $84.53. So roughly around $85 with an oversold RSI and MACD. And of course, on the daily time frame, we're also stabilizing a little bit. That is going to be that next support level to watch at 84.50s for e.l.f. Beauty. And now if you bring up the moving averages as well, so we've got the 200 SMA. It's now trading below the 200 SMA. It's also now trading below the 50 exponential moving average. And if I bring up the 300 simple moving average, that is going to be over here. The second one, we're going to check this box off, and there we go. And boom, it's sitting right at the support at $82, $83. So this right here is going to be that support level to watch, and that's also in line with that 300 simple moving average. And in my opinion, that could be a very good support and a technical area of demand for e.l.f. Beauty. But this right here is the overall downtrending channel within which it's trading at the moment. So trend not in the favor right now for the bulls. The overall direction is lower highs and lower lows, but $83 is going to be a very nice support and an area of demand for e.l.f., considering that that's where the 300 estimate is, and also a previous support level that we have marked in the past. And my intrinsic value obviously sits at $81.75 to as low as sub $80 is when I do believe the stock could also be considered undervalued, given very conservative growth rates and a P multiple that's going to compress down to 22 to 24. So hope you guys enjoyed this video and a complete update on e.l.f. Don't forget, join our Discord, Patreon. There's going to be a lot of analysis and research included. Unlock over 40 plus videos and private videos and members only lectures, and of course unlock 20 plus Discord channels, including trade ideas, alerts. Everything's going to be included. As always, happy investing, and I will see you all in the next video.